Thank you, Mr. Chairman. Let me say this to the panel. When I first started making inquiries as to mark-to-market and the distortions in the market, the first reaction I had from many at the SEC and FASB and in the accounting industry was this guy doesn't know fish buckets from accounting buckets, and he doesn't know bed sheets from spreadsheets. There was some truth in that. Started to say a lot of truth. But I had been hearing from bankers, I'd been hearing from lenders, and I'd actually been hearing from bank regulators, both state and federal, that there was a real problem. I requested this hearing October the 3rd. Now, that was not some coincidental date. That was the date that I received the letter from Robert Denham, your former boss, Mr. Hurst, which basically, as far as I read it, told me to, he said, we don't need any political interference. That was also the same day we passed TARP. And the reason for his letter, among other things, was that Roy Blunt and I included, legislation in the TARP that said study mark-to-market and determine whether it is distorting valuations or loan provisioning. We also troubled by when there's an acquisition, a purchase accounting. As a result of kind of a back and forth, the Washington Post on October the 28th, quoting accountants, basically said, don't blame mark-to-market accounting. I never have. I never have. I'm not blaming it, and I know the chairman of the subcommittee said it's not the cause of the crisis. No one thinks it is. But a lot of us think that its application in certain respects has worsened it. Not only us, but Chairman Bernanke, Mr. Dugan, regulators, people I respect. Talked to the former CEO of a bank that was listed as one of the 10 safest. He's a former CEO. He says it's a real problem. You heard Ms. Bachman. What many members were advocating was suspending mark-to-market. I was not doing that. I told the Washington Post, and here's what he said. The guy, he tracked down. He tracked down the guy, like I'm in a cave and they're pulling me out. The guy who got that provision in the bill, Representative Spencer Bachus, the ranking minority member, he told me he wasn't trying to politicize accounting. I'm not. It just says study it. It doesn't say study it, study to repeal it. It doesn't say do a study to suspend it. But the SEC studied it at our request, and they came back and said it's causing some real problems, and they kicked it to you. And there's been nothing done. In fact, from January to, over 2 months, I think December to February, it took 2 months for you to even announce y'all were going forward with the study. And now you're saying it's going to be 3 months. You've said, you've identified some problems, but it's going to be another 3 months. One of the things that disturbs me, and you can answer this, you keep saying that you're defending investors, people who want to buy stocks or banks or whatever, these assets. I understand that, but what about the investors that hold them? What about most Americans who hold those investments and are seeing them unduly diminished or distorted in value? I've discussed with members of your staff, and let me answer this. I'm not an accounting, but I went back to an old accounting book, and it defines fair market value, which is what we're supposed to have, right? And it's not, it seems to be a little different than mark-to-market. I mean, y'all use them interchangeably, but they're not. And I'm glad you agree. It's fair market value accounting, which is what we're supposed to have, the price at which property would change hands between a willing buyer and a willing seller. Now, when you come in and put mark-to-market, and I'm not an enemy of mark-to-market, you're distorting to me, the free market, because the free market is a willing buyer and a willing seller. And until you have that, you don't have a transaction. And I've really never had a satisfactory answer to that. You know, mark-to-market assumes that you don't have a buyer willing to offer intrinsic or real value, and you have, or that you have a seller that's got to sell. If I put up my house today and I don't get an offer for a week, I don't have to sell. But mark-to-market would presume that I had to sell. If I got in my car and it wouldn't crank because the battery was dead, I wouldn't call folks over and say, buy this car. They'd say, well, I'd like to drive it around the block. Well, the battery's dead. I don't have to sell it, nor do I have to take it to an auction tomorrow and sell it at an auction. I'll just hold on to it. And that's what bankers tell me every day. But mark-to-market reduces their reserves and is causing them real problems and distortions. And here we are today. I talked about John Lewis's book. I'd invite you to read those 2 pages. I really would, because I want you to buy into this as an urgent situation. You knew that I was upset by Mr. Denham's letter, but I didn't respond by going back at him and telling him we're going to do something. I requested this hearing in October. I requested again in January. And let me say this, Mr. Garrett. I've not given them 6 weeks. I first contacted you in July of last year. And since that time, a lot of my constituents have had loans called. A lot of the businesses, the people I represent, have gone under. I would never blame you. I would never blame the accounting industry. In fact, let me say this. Empower your accountants. Empower your accountants to value property even the way they would like to. Give them some flexibility. And in doing this, please remember, in my opinion, that mark-to-market, it really interferes with the free market, because the free market is a willing buyer and a willing seller. And until you have that, you shouldn't have a transaction. And when you assume or force a presumption of a transaction, you devalue property. You devalue assets. You devalue loans. And to the bank regulators, y'all been telling me for 4 or 5 months there were problems with. I've got a letter where we swapped a letter back in August where you said, you know, it's really hard for us to get an acquiring bank to buy now because you have to write down the asset. I said, well, why don't you change the rules or go to the accounting board? Why don't you go to the SEC? Because that's cost taxpayers billions of dollars because that rule hadn't changed. And I mean, the regulators have said since July it's not the right way to do it. When one bank buys another bank, all the assets have to be written down.
Why do the rest of us have to?
You know, we've all agreed for some months now that shouldn't happen, but it continues to happen, and taxpayers, sometimes a bank is not bought, it fails because of that obstacle. So, you know, join us in this House. We're not trying to politicize accounting. We're not trying to suspend the rule. But I'm going to go back to the you know, what I've always thought. You don't have a willing buyer, you don't have a willing seller. That's what fair, isn't that what, isn't that the definition? The price at which property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or sell, and both having knowledge of the relevant facts. You know, that's basically what a lot of banks do. They're not going to sell. You know, but what you're doing by some of this accounting thing, you're forcing them to write down their assets, which devalues their capital, sometimes causes a run on their stock, and then they have to sell. I appreciate it very much.
Thank you very much.